Okay, so we are what are we? Thursday, 22nd of May, just on 1:32 in Ireland. And we've had some of this jobless data out of the US. Initial jobless claims 227, miss on the expected 230. So everything's pretty okay there. Prior 229. So initial jobless claims actually dropping. Continuing jobless claims rising, one spot 903,000 on expected 1.890. So yeah, pretty good. Pretty good. Uh, Nothing to worry about. But what the market is worried about at the moment is this bond auction, right? And so what we saw in Japan was the 30-year bonds are now at all-time high at about a yield of 3.43 or 3.48 or something like that. Now that's something to note in itself. And Japan is in a bit of trouble here, right? Rising yields, but also the same has now happened last night in the S&P and in the US bond market. Now this is a screenshot from News Squawk that I posted on the VWAP report notes yesterday on Substack, and you'll see here that the if I kind of zoom in just to make this super clear, right? So you see in the 2-year, 3-year, 5-year, 7, 10s, 20s, 30s, right? Okay. So ultimately the auction was pretty weak because they went out to market here trying to get the bonds off at a certain coupon rate, and the market just rejected the rates and put in a tail of no trade, and the yields actually went, could only trade at a higher yield. So what you saw here was, mainly the 30-year went up 12.2 basis points to trade at 511, 5.112%. That's actually now moved to 5.15 as we're hearing here in real time from Squawk on the 10-year, or sorry, on the on the 30-year ultra bond. I think that's correct. Um, don't quote me on that, but this is what happened yesterday. So let's keep with this, okay? The 10 years are now at 4.3%, 4.363. So again, moving up 9.6 basis points, and the 5 years going up 5.1 basis points to trade at just shy of 4% here. So why is this important? You're like, Tim, I just want to sling contracts and, my CFDs or like whatever, or futures or blah, blah, blah. Well, really, when this auction started trading last night, the S&P came up super hard, right? And you'll see on the charts here, if we just blow up the SPOOs here, we'll just blow this one up here, right? And you can see last night what happened here. Now we could probably even shift down to I don't know, we'll go with a 5 minute, right? We'll go with a five
Just for
minute
the
chart.
Ags watchers, no, IGC has maintained its 25-26 world wheat crop forecast at 806 million metric tons. That's 806 million metric tons.
806. We need to monitor that figure, guys. From yesterday's conversation. Okay. But you see here what happened through that auction, right? The market just completely, pretty much this is when the auction kicked off.
The geopolitical situation between Pakistan and India. Pakistan's Attorney General says for Pakistan.
I'm just going to kill the squawk in the background here. There's a lot going on at the moment, and really great coverage from the guys there on the desk on this bond situation. But anyway, this is what happened during that bond situation last night, that bond auction, okay? And so if you don't think this matters, well, it does. Now, why does it matter? Okay. Well, it matters because when you're investing in multiple different products, the risk-free rate is pivotal to how you're judging the returns on said investment, whether it's you're investing in holiday cottages in the west of Ireland to investing in e-bikes in California to whatever. All right. You're talking about, am I able to get better than the risk-free rate by getting into the whatever your investment is? Okay. And when these bond yields are low, well, it's like fine, okay. Like I might be promoter of a project, like an entrepreneur, and I'm saying, listen, I can do you a return of like 8% over over 5 years. And then net with tax and all, blah, 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 that actually kind of works out at like more, it's going to be more like 5% after tax, right? Something like that. Okay. But, there's lots of people from venture capitalists to investment banks that offering products that have yields on those products for the investors who get into them that are trying to achieve. Obviously, they're trying to beat inflation, but they're also trying to beat the risk-free rate. Why would or else why would they? Why wouldn't they just go and buy some U.S. bonds, buy some German bonds, buy some French bonds, buy anything that's just is at the risk-free rate? Okay, so if you look at the 5 year here, for example, it's now pushing up 4%. Well, if you take a VC fund that wants you to put money in with them because they're going to invest in AI, and they're saying, well, over a 5 year term, we're going to offer you like 8%. And I go, well, hold on a second. A 5 year term, and I'm going to get 8%, and then after tax and expenses and I'm actually like at 5. Well, I'm adopting a lot of risk because you guys might blow out and pick the dogs instead of the thoroughbreds. So you're adopting a lot of risk. So I want to get paid a bit more. And they're saying, well, yeah, well, we're giving you 8%. And you were like, yeah, but after tax, 8%, I'm actually like getting 5 or 6, maybe at best. At best, you get 6. All right. So let's just call it 5. Well, I go, you know what? The US 5 year is actually just around 4%. Maybe I'll just go with 4%, and then I'll end up with 3% after tax. I'm going to beat inflation, but I'm adopting pretty much no risk. Okay. So as these rates go up, people draw money out of risk assets, pull them out of risk assets and put them into bonds. So you get this vacuum of money out of risk capital happening. And so essentially that's kind of why at these really attractive rates, like, you can get a 30-year bond getting paid 5.112%, or you can go down the road and you can talk to Shady O'Grady's investment managers, who's going to adopt all the risk, all the volatility, and you might be picking dogs instead of thoroughbreds, and hey ho, we lost 20% of your capital, and we just want to, you probably just want to get out. All right. Well, I go, you know what? Instead of doing that, I'm going to go and I'm going to get 5.112%, and I'm going to be happy as a cricket. Right. So that's just one thing that happens when these yields go higher. Let's talk about another thing that happens. US sovereign debt goes higher. Whatever 32 gajillion billion quid that the US owes, there's no amount of good work that Elon and Doge team can do to counteract at this level of ticking up on these bond time horizons, on this bond yield curve here that we're looking at, right? I mean, the 30 years gone up 12.2 bips. I mean, that's probably, I would say, 20 to 30% of the work that Elon Musk has done is just gone. The savings, Now he's talking about 2 trillion over a very long time. I mean, add another 2 trillion onto the debt burden here, boys. So things are shaking and rocking here a bit. Does it all matter? It does if you're looking for the catalyst. Is it important? Yeah, it's important. And the closer the 10-year gets to 5%, the more things are going to be a little too speculative, and the more it's going to draw risk capital out of equity markets. And that's my view. I didn't go to economist school. I didn't go to central banker school. I'm just another guy out here, looking to make money. Anyway, let's have a look at the markets, and I'm going to make sure that everyone's able to access that portion. So we're going to go back to the markets here and have a look at what's going on. You can see here automatically SPOOS is rejected there. I remember talking to Darkstar in this room yesterday when this was happening. This was a trade was on. It's an IPV short on weekly VWAP, and I had no idea that this was going to unfold on the bonds, but yet it did. And so hitting that weekly P-val on pretty much around the close there. So we're just kind of drifting to the downside. Where are we going to go to today? Yearly PVH confident with monthly VWAP. Now, that's a target. Is this going to be a turn point for the market to then kind of get back on that 6-day streak that we had since Scott Bessent cut a deal, well, a pause deal with the Chinese in Switzerland? I don't know. I don't know. It's very hard to tell, but technically, I like the buying here. Down at 58.06 quarters. Well, call it 58.01s monthly VWAP. Now, what does this look like on a daily bar chart? Well, I'm going to hide one element here, and then we'll just do this. And this is what it looks like. So that because of that deal Scott did with the Chinese, on the pause, obviously the market absolutely clamored over themselves to buy that, and we got this gap up open, and that is this area in yellow is the outstanding gap. Areas to trade on the way down. We just looked at Y VWAP, or sorry, monthly VWAP, confluent with Y prior value high. I think that's going to trade. Maybe we get some relief off of that today, but I could easily see this thing trade and actually go for closing the gap over the next 5 sessions. And actually, if we dip into this area, I think that's a really bullish for the market to test down here. So that's it really. The amount of stick I got for talking about how the spoos could potentially sell here off of the Q, and I'll just kind of show you that setup that I was talking about with Jason was a rejection here and down. To revisit the lows on the year and sort of tidy up a bit of trade undone. Then here, taking a lot of stick, guys and girls. I don't care. All right, I people are like, Tim, you haven't got a clue. Who is this guy? Whatever. I don't give a shit. All right, I'm just out here trying to make money, and I'm just out here trading an edge. All right, that's what we're all doing, and that's all I really want to say about that. So, anyway, I think it's really bullish down here. Close the gap and then get running off the QP val and restart that auction. That has a lot of potential to restart for the Q, which would then eventually lead us up into 58 or 50, 59, turn around there, and potentially into new highs. But things are looking shaky on this bond situation right now. All right, that's a spoos. Another market that is hotly, we can't really go anywhere without looking at the bonds. I think the bonds need to drop even further here, to be honest, and trade that QP val level 108.19s, and that is going to be this. This is the 10-year here, and that is going to be another massive push up on the yields for the 10-year. So I'm definitely open to that today, but maybe just a little bit of a pullback today before then peeling off to the downside again tomorrow. That could be a bit of a 1-2 situation. They threw it at them last night. They'll probably take it back a bit today, and then they'll throw it at them again tomorrow. Another one to look at here. I wish we could go through all the equities. I just do not have the time at the moment. And we have had some data come across. Not yet, actually. No, we're just waiting for a bit more data on services PMIs in an hour. Oil. We'll talk about oil. Here's oil. Just cannot live above this line in the sand. So I was long USO options over the past probably 2 weeks, and out of that now. Didn't really do much. But really the push and the pull here, and one of the reasons why this week's oil report was called Narratives is because there are some really, really beefy narratives, and please do go and check out the VWAP report or the oil report this week, because there are some really strong narratives playing out in oil that need attention. It's essentially, will they or won't they get an Iranian nuclear deal done between, Trump to broker it? It's really a nuclear deal. Trump is trying to broker this and get it done. He's keeping Iran on the sweet side. And so if they don't get the deal done, that's about 1.7 million barrels kept off supply. If they do get the deal done, that's about 1.7 back on supply. Now, in the middle of this narrative, you have basically the number one scumbag in the world, Netanyahu, then coming forward because he is at odds with Donald Trump, saying that he's going to bomb Iranian nuclear facilities. Now we've had it this morning that Iran have said, listen, if Israel bomb our nuclear facilities, we will consider that as a U.S. involvement. Okay. So things are really just, a little bit to and fro at the moment on this thing. There's a lot pivoting on this narrative. In the background, there's another narrative where IEA have miscalculated the demand supply, well, really the demand picture for the last 4 years, 3 years, really, totaling anywhere from between 75 million barrels and 300 odd million barrels of oil that were kind of unaccounted for, okay, in the demand picture. Okay, so you might put on your tinfoil hat and say, well, maybe there was an administration-led miscalculation from IEA where they kind of wanted to show that there was a huge drop in demand over those last 4 years going forward, because there was a big divergence between IEA demand forecasts and OPEC demand forecasts. And now finally the IEA have actually come out and said, yeah, actually we got it wrong for the last 4 years. And just by the way, the delta differential between what OPEC are looking at, we were looking at, is it's been about 75 mil barrels on the soft side. So that's another narrative, but it's really unimportant in the face of this Iranian deal right now. Then another, and I think this is probably the number 2 narrative, is that U.S. oil is tipping. All right, production is tipping. All right, and production is kind of slacking off a bit, and that's probably to meet, this uncertainty, right? This word uncertainty around the tariff situation. But net, even with the Swiss pause deal, and I talk about this in the report, even with the Swiss pause deal, China are not coming back to market to buy WTI or Henry Hub nat gas. A lot of that Henry Hub nat gas is now going to export to Europe. Okay. So that's kind of a quickie update. There is a lot more detail in the VWAP report and in the oil report, guys. Just to kind of cover maybe something else here. Gold. Oh, gold. I mean, how much can people talk about this market? Look, we dipped onto the Q-1 here, found buyers. This is actually a yearly half deviation. Myself and Max were kind of looking to play this, and then we actually didn't because the support's it was a bit of a mixed picture. We're actually waiting for something a bit lower to test on gold, and happy to do so. But they are really bulling this market quite hard. It's China, they're back. It's a lot of the central banks, they're back. See, there's your half deviation touch on gold, and then keep going up. Here was a prior half deviation touch, and here was another, and there was another one back here in January. So we're just sitting on our hands here. I do have bullion bought though, and I'm looking to buy a bit more, but I don't want to get involved at these all-time highs here on the next tier end. I'd rather get something down here, which needs to be revised up to currently today 3024 yearly VWAP. All right, so that's it. I think we've gone around the houses here, and we'll pop that back in like this. Nat gas, a bit of a wishy-washy range at the moment, but ultimately we like the future for nat gas. We got some grains as well that have some crazy readings on CLT at the moment. We might try and hook Jason into a discussion about some of that. All right. Thank you very much for listening. Be careful out there. I think we have some more selling to do here on equities, and I'll talk to you later. Cheers.